BlackRock Income Growth, or BRIG, is an investment trust situated in the UK equity income sector and benefits from the experience of its two co-managers, Adam Abdgori and David Goldman. Now, the pair look to deliver robust capital and income growth over time, and they do so by primarily investing in UK companies, with a real emphasis placed on those that can offer growing and sustainable income over time. And like most managers, they really focus on stock specifics and bottom-up fundamentals and prefer to wade through market noise or any short-term market trends that we are often faced with. And they hone their efforts then on focusing on the stocks that they believe are best placed to help them deliver on that trust objective. And this often steers them towards building higher conviction positions in the portfolio, resulting in a relatively concentrated portfolio of around 40 stocks. Now, to be considered into the portfolio, these companies need to demonstrate a number of different traits, one of which being really strong, healthy balance sheets. The managers want to see robust, strong and sustainable free cash flows. They also want the management to be competent with a good track record of running the company, but also disciplined when it comes to allocating that capital. Now, this steers them toward those high quality companies, but they also pay attention to valuations. They want companies that are attractively priced, undervalued by the market. They also place a significant focus on companies growing their dividends sustainably and avoiding those with the high immediate incomes. So stylistically speaking, you can think of Adam and David's approach, and indeed BlackRock Income Growth as a trust, as more balanced than most peers in the sector, because they are avoiding the really deep value, highly cyclical companies, those cheap stocks, and they're also avoiding the aggressive growth businesses that perhaps are unprofitable, and instead blending aspects of the two strategies to focus on quality companies that deliver a growing and sustainable income over time. Okay. In terms of attractiveness, there are a few things we can point to with the BlackRock Income Growth Trust, and I think it makes sense to start with the market in which they invest in and the resources they have available to them. So within the UK, there's a fairly big valuation dispersion, and that is offering investors some potential significant opportunities. And what we mean by that is there is a wide spread between the most expensive UK stocks and the least expensive UK stocks. And those considered least expensive are trading at historic lows, whereas those considered most expensive are trading, in some cases, at comparable levels to the US, high growth US businesses. And the managers believe that while some of these companies can justify a low valuation, many of them are not undervalued because they're poor businesses or have weak fundamentals. They're, in fact, very strong businesses with upside potential. It's just they've had to withstand prolonged macroeconomic pressures. And by that we can talk to geopolitical tensions, we can talk to the impact of interest rates and inflation over the last few years, and even political instability as well. So moving into an environment where political stability stabilises somewhat, at least it's less polarised than parts of Europe, and the economic outlook improves and strengthens, these undervalued opportunities offer a pretty significant re-rating opportunity. And the attractiveness element here comes through the manager's experience. So David and Adam are very experienced in the UK sector. They've been doing it for a long time, and they're well versed with the companies in their universe. But they can also draw on the vast resources at BlackRock. And in years past, BlackRock have highlighted that in some years they can do upwards of 1,000 meetings with UK companies and management. So really leaving no stone unturned in the UK to find those attractive opportunities. Another attractive element we'd point to is their allocation overseas and their underlying revenue streams from the UK portion of the portfolio. So like many trusts in the sector, BlackRock can invest up to 20% in overseas businesses. It's currently around 8 to 9%, so that really reflects the conviction that the managers have on the opportunity set on the home soil. But the allocation they do have overseas is very specific. It fulfills a purpose. They believe there are certain gaps in the UK market, and they fill those gaps by looking at overseas companies that they also feel are high quality, that are undervalued, and that offer something unique to the portfolio. So an example we can talk to is MasterCard, which they believe does not have a truly competitive or listed equivalent in the UK. In terms of the underlying exposure, UK companies generate or derive a large portion of their revenues from overseas, so you're not tied to the fortunes of one economy despite investing in the UK. In fact, you've got global opportunities as well, and this really enhances BlackRock's streams of income but also drivers of capital growth. In terms of performance, BlackRock Income Growth has done very well over the long run. Under Adam's 12 or so year tenure, it's ahead of the benchmark, and the benchmark being the FTSE All-Share Index. And we think this can be attributed to the manager's differentiated approach to capital and income investing. They employ a much more balanced approach than a lot of peers in the sector, and with that comes some defensive characteristics, particularly when you consider their more cautious approach to gearing. So over time, they've been able to generate really strong returns and maintain a very sustainable and growing income for investors. When we look over the last 5 years, performance is much more mixed. We've had some pretty significant rotations in investment styles. So we've gone from growth to value, value to growth. And for a balanced trust such as BlackRock Income Growth, this has hindered returns somewhat. Another aspect potentially over the last 5 years that have held things back is their allocation to smaller companies, so those companies in the small and mid-cap part of the market. Whilst they've been very strong over the long run, they're more domestically sensitive, and given the economic pressures that we've had in the UK over the last 5 years, this has put abnormal pressure on those companies to perform, so again that's hindered returns. But the manager's balanced approach has kept pace with the market. It's broadly flat, despite having significant periods of style being in play, which we think is a positive. And having that defensive element, along with a fairly cautious approach to gearing, will buffer volatility somewhat in periods of market turbulence. And the same can be said over the last 12 months. It's been a pretty volatile period for markets, and whilst things are improving, BlackRock has marginally kept ahead of the index, and we think that defensive approach, that balanced approach, focusing on those stock underlying fundamentals that we mentioned earlier, have really helped with that. And when you consider BlackRock's current double-digit discount, which is around 12%, investors looking for a differentiated exposure to the UK with undervalued stocks that still retain that quality nature and sustainable growing income, BlackRock Income Growth could be that option for them.